Hello traders, this is Options 101, Lesson 7. A quick look at swing trading versus day trading options. I'm going to show you the reality of the thing so you can judge for yourself. Alright, the real problem is that most traders that try to trade options are losing money, even if they are directionally right when they are day trading. Why this happens? Because options are not stocks. And day trading options means fighting the actual structure of options. Now, the real killer here is the bid and ask spread. So I'm not even talking about commissions. I'm just talking about bid and ask spread. So as many of you know, when we have stocks, you have few cents of spreads. Maybe sometimes you 1 cent of spread. Massive liquidity, and the fills are instant, almost instant, they're fast. In options, we have wider spreads, wider bid and ask spreads, lower liquidity. The price discovery happens slower. So option spreads are structural, not accidental. This is an example, like an extreme example. But on some stocks, it also happened to have a bid price, for example, of 4 and ask of 7, and the mid is 5.5. So it's like a $3 wide spread. So it's a lot. It's not usual, but it can even happen. There are some options chains that have crazy spreads, and that you want to avoid that even with swing trading, not only day trading. All right, so let's make an example. Now, let's imagine we are day trading options, okay? And we decide to buy an option. Let's say we buy a call here. We go in our option chain. We decide to buy an option. Let's see what happens from a day trading point of view. So let's say the bid is 235 and then the ask is 265. The mid is 250. Let's say you are shaving the spread, you're behaving right, and you place a buying limit at 250 and you get filled, which is good execution. There's also some traders that they even get worse orders. They don't even shave the spread, don't even go for the mid price. But let's say we're behaving right and we shave the spread, we place a buy limit at 250. So now my entry price is 250. My mark to market value, the bid, is 235. So from the moment I put on this option trade, my unrealized P&L is minus 0.15. So it's minus $15 per contract. And this happens before any price move, before the market does anything. You're already down $15 per contract. So this is your entry tax, and this happens all the time. Now, day traders don't notice that because they usually look at P&L moving and the option price ticks. So they don't see the spread cost, this hidden slippage, and they don't realize then they get these worse fills. So the loss is real and it's going to compound. So it's a huge problem. Scalping, it's a big example of why day trading doesn't work with options. So a typical day trade target is 0.10 and 0.30 cents. A typical option spread goes from 0.10 cents to 0.40. So the spread can eat your entire move, leave you break even if you're lucky, and turning a winning trade into a losing one. So you need to keep that in mind. So now, even if you're right, let's make an example how you could lose anyway. So if you buy an option at 265, okay? Of this, you buy an option and the underlying stock is this chart over here that is moving higher. You say we bought a call at 265 and the stock, the underlying moves higher and the options move to 2.80 mid. Okay. So now the new prices on the bid and ask will be on the bid 265 and on the ask 295. So if you sell at 265 because you sell at the bid, your profit is 0. So you were right and you made nothing. So that's how important this is. You were right and you didn't make any money. Now, let's add to this the exit spread. So you pay the spread when you enter, you pay the spread when you exit. So the market has to move twice just to cover this friction. Option trading, option day trading, it's not working okay. It's brutal. It doesn't work. It just doesn't work. I heard a lot of, some trading influencers saying, I trade option just once. I day traded them just once and it was horrible. It's not good in my opinion. It's shit. Yeah, of course it is, because you don't know how to trade them and you're not aware of these important factors. Fast markets are even worse for options because during news, earnings, volatility spikes, the VIX goes higher. There's like OFNC meeting, interest rates, some news, some CPI numbers that were hotter than expected and so on. The spreads, they widen instantly. They could jump, for example, from a 0.25 spread to a 0.55. Like your edge, it's already gone by doing nothing. So why swing trading instead makes sense and changes actually everything. And it should be the only way you trade options. Let's make another example. We want to buy another option. We go on an option chain. We want to buy this call. We see the quotes and we have at entry, the bid at 235, the ask at 265, the mid is 250. The spread, so it's 0.30. Okay. We place a buy limit at the mid because we're good. We shave the spread and we get filled at 250. So this is good execution. So our entry price is 250. Our market value, the bid, is 235. So the unrealized P&L at the moment, without doing anything else, it is minus 0.15. So minus $15 per contract. But now we're swing trading. We're not day trading. So we're giving the trade the time, we're giving structure and room to develop. And this changes everything. Why? So we have this nice underlying, the stock. We bought this call, all right? And the stock moves in our favor. So we have over several days, we have the option that is appreciating, is increasing in value because the underlying is moving in our favor over several days. So the new options quotes will be, for example, the bid at 4, the ask at 430. So we're going to have a mid of 415. The spread is still there. So nothing different happened, right? But now when we exit, so everything went well in our direction, we decide to exit the trade. We sell at the bid because that's how options work. So we decide to sell. The entry was at 250, remember, and the exit now is at 4. So our gross profit is plus 1.50. So plus $150 per contract. So we paid 0.15 on the entry, 0.15 on the exit. So we have a total spread friction 0.30. So now our net profit after the spread is simply 150, our gross profit, minus 0.30 for a result of 120 per contract, $120 per contract before commissions. This works because the spread is still there. You still pay it, but it becomes small relative to the move. So even entering the trade now makes sense. So the option moved 1.65 on the mid and we capture 1.20 net. So the spread becomes a minor cost and not anymore a make or break situation. So you pay the spread once with swing trading. We let the delta accumulate. We let the option underline move in the direction that we want. If we're lucky enough, we allow the probability to unfold and we are not forced to trade noise. This is actually great if you think about it because we are not forced to trade noise. We can live in a happier and more peaceful trading life. So that was it. I hope that everything was clear and please swing trade options, don't day trade them.